Chapter 5, welcome. So what are we going to be doing now? We're going to be taking a closer look at the evidence and the documentation that we gather to validate our ultimate opinion on the financial statements. Again, it's only an opinion, qualified or unqualified, or adverse, a couple of ways to go, or we withdraw from the engagement. But the key here is doing enough tests so we can support any conclusions we draw. So what are we trying to say? Well, as we said, chapter 5 is evidence and documentation. And how are we going to handle doing that? That's what we're going to be talking about. So audit evidence related to the report. We're going to examine financial statements, management assertions, execute a bunch of procedures, generate the report, reach a conclusion, and finally evaluate the fairness of the financial statements. Ultimately, everyone's hoping we get an unqualified opinion. No problems, no issues, things are presented fairly. So what are some of the assertions that management's going to make? Well, they're going to start off saying, well, the stuff happened, it occurred. Everything's there, it's complete. Properly authorized, the right people checked off. It's accurate. Proper cutoff on the timing, it happened December 31, it happened January 1, or whatever the fiscal year end is. It's properly classified, it's in the right account, and it's fairly presented. So management has things they're saying. A few more things they're going to say. All this stuff existed. It's legitimate. Rights and obligations, we are filling those obligations and those needs, and we have the rights to whatever assets or whatever we can claim. Records are complete, accurate. Things are, again, properly classified and effectively and well presented. So the audit evidence is what the auditor is gathering to confirm those conclusions and what the ultimate opinion is based upon. So, understanding audit evidence. The information we used as audit evidence is sufficient and appropriate, and somebody else that's looking at it would come to the same conclusion. So we have to evaluate the audit evidence ourselves, but keep in mind, if it ever gets reviewed, if there's ever a question, somebody else might be coming in and reviewing our work saying, that is adequate, or maybe that was inadequate. So what information are we going to use for the records? Well, we'll go directly to the accounting records. Okay, initial entries, supporting records. We've got our ledgers, journals, other adjusting entries that are not adjustments not reflected, but adjusting journal entries. We get the worksheets, the spreadsheets, a bunch of supporting documentation, supporting tools, reconciliations, bank recs and the like, contracts, and all that supporting information. How about other things that we gather? Okay, so we mentioned reviewing board minutes and meetings minutes of not only the boards, but actually maybe some other internal operational things going on. Third-party confirmations. We're going to get verification from outside of the organization that yes, monies are owed or transactions really did happen. Industry analyst reports. A lot of folks outside have interest in the company and they have exposure and they can do analysis and they can interview people and get some pretty interesting information. Comparable data about competitors. What if somebody said, okay, let's audit Bernie Madoff's books. Why is he making money when everybody else is losing money? There's a question there. So how are competitors doing? What's the industry doing? How does the industry look? Control manuals. What are some of the procedural manuals and the controls that you are maintaining internally? And how about information obtained from inquiry, observation, and inspection? Having that conversation is a communication thing. Just observing. If you see folks scrambling, you see everybody at 4:45 walking out the door, and you wonder about their commitment to getting things done or making errors as they might, those are legitimate things, or inspecting as you go. Do we have adequate audit evidence? Is there sufficient quantity of evidence? If there's a greater risk of misstatement, we need more stuff. If the quality of the evidence is very high, though, maybe we need less of it. So those are some tools in our toolbox that we can work with. Appropriateness is a measure of quality of audit evidence. Is it relevant and is it reliable? Appropriate stuff. Independent sources, effective internal controls, auditors' direct personal knowledge, industry, personnel, documentary evidence, and the original documentation. We examine the evidence, follow the evidence trail. Proper evaluation of evidence requires an understanding of the types of evidence that are available and the reliability associated with that evidence. And the auditors does need to be thorough. And also key is unbiased. All right, so what are the specific acts that the auditor does to gather evidence? You have risk assessment procedures, substantive procedures, and they have tests, controls that go with it. So some of the audit procedures. All right, so existence. We got to confirm stuff is it real receivables? Is it really there? Are assets real? Rights and obligations. Maybe there's factoring of receivables. We sold those receivables, even though people say they owe the money. Is it really a company that owns the rights to collect those monies? Is it complete? Are the subsidiary ledgers including all potential transactions that they should? And then the accuracy, valuation, or allocation. All right, so we want to test for allowance for doubtful accounts. Maybe we're trying to, and that's, recall Health South, that was one of the real things that got started. Let's change our allowance for doubtful accounts from 2% down to 1.5%. That way, we're not expensing as much, we get a little more income, and Wall Street's happy. And then the next quarter, it was, well, let's make it 1% and try making it 0%. What do you mean? We collect everything? Probably not. And then they started making up transactions. They had spreadsheets upon spreadsheets of fake transactions. So Health South was not a good example. And that was right about the time of Sarbanes-Oxley as well. That was SOX implementation. I actually knew one of the CFOs there who did jail time, where the president didn't. It was interesting. All right, so how about some other procedures? Well, we get something called vouching versus tracing. Vouching is taking the books and saying, oh, let's go find the supporting documentation that supports that transaction in our books, in our journals and ledgers. Tracing is saying, let's go to the file cabinet with the source documents, or go to the electronic filing cabinet that contains those source documents and go see that things got signed off properly. So, and make sure they made it properly into the books. So that's vouching and tracing. It's kind of an important distinction to be aware of. How about physical examination? Again, we look and say, okay, yeah, this stuff is here. We look at inventory, that stuff is there. And we can watch others process and execute. Maybe others doing a physical inventory, or others in the process of doing their activities we can observe. How about inquiry? We got to ask and consider the experience and qualifications of who we're talking to. So, and the level that we're talking to. It is about communication. Key to not, you can't just bury your head in the books, hide behind the numbers. You're talking to people, and people are sharing information, and you're gathering information, and you're recording that information. I once had to do an audit in Boston, Mass Bay Transit Authority, MBTA, fraud audit. It was my first jobs when I came onto one of the big four firms, EY. And I had to see if Dunkin' Donuts was actually paying the right percentage of their percentage of revenue sales that they had to pay to the authority, because that was their agreement. So I had to tick and tie and say, okay, rush hour, how much do they have in sales? The quieter times, how much do they have in sales? I actually went and spoke to the owner, inquiring about, how's business been? And this, he probably knew I was an auditor because I was probably dressed up in a suit, but I was also under the guise of, I'm looking to run a business. How you doing? And if I opened up another shop somewhere, came into the Dunkin' Donuts family, and the corporate headquarters is in Boston for Dunkin' Donuts overall, but this was a franchisee, and how he was doing. So it was a communication, it was a chat, and it was trying to understand what they did and how they did it. Asking clear, concise, and relevant questions. That's part of the interview technique. The interview for a job, you're going to get all kinds of questions, and you hopefully will have clear and concise answers. And then you will be asking questions. Same thing here it's an interview. You're interviewing personnel, trying to gather data, gather information, and to see if things are effective. Listening skills cannot be overemphasized. 2 ears, 1 mouth. I guess we're supposed to listen as twice as much as we talk. but yes, listening skills are valid. How about the reactions? We ask a question and somebody gets a little bit nervous, or they start reacting. And maybe we need to do a little further follow-up and analysis and ask some deeper questions. Yes, we need to evaluate the responses and note it down. Just because we hear something doesn't mean, okay, we can say it's good. We got to note it and our interpretations will go with it. So how do we gather some evidence? A couple other ways. Confirmation. We send out and request written responses from a third party. So these confirmations get sent and sent back to, or confirmation requests get sent out. Confirmations get returned saying, yep, amount's right, or no, it's off, and if there's some pretty big tickets and we don't get responses, we need to do a deeper dive and follow through. How about the reliability of the evidence? What's the form of the confirmation? And what the prior experiences might be. Nature of information being confirmed and intended respondents. So let's talk about some of those respondents. So cash balance, who knows better than our bank? We're gonna look at the statements and the reconciliations. Receivables, we'll reach out to customers, especially the larger receivables saying, hey, do you really owe the money? And if we don't get a response from some of those big tickets, as I say, we need to do a deeper dive, analyze, and look at an alternative method for evaluation. Inventory on consignment. Okay, the consignee, not all the inventory is in-house is really ours possibly. And so we need to have a conversation or a validation or confirmation through the consignee. Accounts payable, the vendors are going to know what they're owed. The bonds payable, bondholders hopefully, or the trustee will know what they are holding on to for bonds. Common stock, registrar and transfer agent. Insurance coverage, yep, insurance company, and collateral. Creditor is going to be able to indicate what they are collateralizing, if anything else, or secured interests. What is recalculation? Well, that's just recrunching the numbers that hey, here's a spreadsheet, and you as the auditor are saying, wait a minute, let me redo those numbers. Let me recalculate. I remember getting the days before we had lots of computer power that says, okay, give me a total. We had to go through pages and pages of reports and tick and tie and validate that the computer printout could add. So that was part of the process. Reperformance, execution of procedures that were originally performed. So that is reperformance on the recount. Analytical procedures, evaluate financial information by a study of plausible relationships among both financial and non-financial data. So we're looking at not only the numbers, but some other insights onto the non-financial side of things. So general guidelines, what's more reliable? Well, high reliability is we can validate, we can verify, we can touch, we can look, we can see. Less is, let's have a conversation. Tell me about this. And that level of conversation is much different. So the assurance bucket, let's see what this is both with. Bottom line, risk assessment procedures, 20%, test of controls, 30%. These numbers may change, but you get an idea of the kinds of things that go in the bucket. Substantive and analytical procedures, and then the remaining assurance from tests and details. Okay, so we want to be able to look at the bucket and be assured that what we're getting is reasonable, accurate, and can be used to support a final conclusion. And then filling assurance buckets, completeness, accuracy, cutoff. We talked about all these sort of management assertions, if you will. And then we need to validate, verify those management assertions based on our tests, our procedures, our examination matches what management claims is happening. So what's some of the documentation behind that? So we have our working papers, serves three purposes. Support the audit report, provide support for the audit report itself. Aid in planning, performance, and supervision of the audit. We're doing the audit. It's a structure of how we're going to execute the audit. And we want to do a review, focal point for reviewing the work of those that are doing the work, the subordinates, the front lines, and evaluate based the quality that goes with that. So what's in the documentation itself? Well, the documentation, again, should be reviewable. An outside party should be able to follow, make sense, and ultimately even duplicate if need be. But how is the audit compiled? And what professional standards? Did it meet the professional standards? You want to support the basis for the conclusions concerning each material financial statement assertion. So we're going to make some assertions, and we want to be able to have that support well documented. And we want to demonstrate whether the underlying accounts records agreed and or reconciled with the financial statements. So is there a match? We need to include written audit program detailing audit procedures. And then we need to understand the nature, timing, extent, results, evidence, and conclusions. And we also want to know who did it. The work papers are going to be signed off by individuals who can make mistakes, but they ultimately need to be responsible. And we need to know who did what. Two sets of files, permanent and current. The permanent are the more of the documentation that has, by definition, more permanent nature. Corporate charter, we're incorporated. Important contracts, maybe real estate contracts or leases, maybe other contracts with vendors, customers. Our chart of accounts should be in place, internal control documentation, policies, procedures, org charts, terms of stock and bond issues, so the debt covenants, prior years analytical procedures, and prior years procedural results. So that's called the permanent files. If we look at the current files, we're going to have the transactions, the AJEs, the audit plan, reclasses of journal entries, a working trial balance, current statements, auditor's report, minutes of meetings, working papers supporting the accounts. Those are the current files that go with the current as well. Every piece of paper, everything or electronic needs to have a name, title, and an entity's year-end date. So what fiscal year are we working in? And then there's indexing and cross-referencing. We go back and forth between different sets of materials and cross-reference between different sets of work papers. So we can go back and forth and find the detailed stuff that's supporting whatever else is in the audit documentation. And then tick marks, those are just some standard notations. A lot of people have their own styles of how they do it. A lot of companies. I remember my 2 weeks in audit training. I went down to Manassas, Virginia, from Boston. I'll tell you, that was the most realistic and most effective training I think I've ever had, where we didn't have enough time to complete. We had to be done by 7 o'clock. We couldn't work until midnight. We had to be done by 7, and there was not nearly enough time to complete all the things we needed to complete. It was very effective in understanding the time pressure, the crunch, and doing what we had to do in the name of an audit and going down that path. All right, so who owns the audit documentation? Well, that belongs to the auditor. It does not belong to the company. Matter of fact, we're out there auditing, and even though we're being paid by the company, we're responsible to the public at large, the SEC, the investors, and we're using the company itself as the platform for the evaluation that we're conducting. We also have to maintain, I believe it's 7 years, what Sarbanes-Oxley requires. Now we need to maintain that documentation. And then if another auditor requests that information, we need to get permission from the client to get the information. But again, if a new auditor if the permission is not being granted to that new auditor probably is going to think twice or 3 times about whether to accept the engagement. They can't get the permission to look at the work papers that the other auditor has. Yeah, so it's a courtesy thing. I mean, we're professional to professional, auditor to auditor. We need to be able to have documentation, which is why you want high quality. If someone's going to review it, you want to make sure that you're doing the job right. As a matter of fact, there's all kinds of audit standards that outside parties will come in and evaluate how you did the audit. Now, even if you're doing it every year, you are responsible for quality, and quality will be evaluated. Purposes of procedures, we have risk assessment procedures, better understand the business plan nature, the timing we talked about. Substantive analytical procedures, obtain evidential matter. Final analytical procedures, basically overall review and the final review stage of the audit. So what's typical? You might have heard of financial analysis, and you probably do this in your basic financial accounting course. We do ratio analysis. We do trend or horizontal analysis. And yeah, we'll do vertical analysis as well, common size analysis. But the big question is it reasonable? Is it making sense? It's back to that smell test. Is it practical? What are your expectations when you analyze? Did our last year's net income percentage was 6%? Now it's 14%. Wow, that's pretty good if it's true. So again, we need to verify and validate. What's the expectation? Auditing standards require the auditor to have expectation whenever analytical procedures are used. So what is the expectation? What is the expectation for bad debts? What is the expectation for total receivables? What is the expectation for impact from whatever we're analyzing, from profits, net income? And sources such as financial and operating data, budgets and forecasts, industry publications, competitive information, management analyses, and the analysts who are following the industry, who have insights as well to the competitors and probably to the company that you are auditing as well. So develop the expectation. What's the quality or precision of the expectation? Potential effectiveness of the procedure, degree of reliance can be placed once we do our testing, and how closely the expectations approximate the correct amount or anticipated. That degree of desired precision differs with the purpose of the analytical procedure. Materiality kicks into gear. And 4 factors affect the precision of analytical procedures. Disaggregation, separating out, the plausibility and predictability of a relationship being studied, how reliable is the data, and what do we use for an analytical procedure to form our expectation. When we talked about materiality, we said, well, we can accept some misstatement, not big misstatements, but some. So what's the size of that tolerable difference? How significant is the account? What are we worried about? Is there a wages payable or a notes receivable for employees? No, how significant? Level of disaggregation is the amount being tested, and the precision of the expectation. How precise is that? And then the tolerable difference will usually be equal to the account's tolerable statement. How much are we willing to accept? Compare the expected to the recorded amount. We better compare. And if there are bigger differences than we really expected, we need to do a deeper dive and find out why. And if those differences are greater, we need to further investigate and observe. More testing is likely. Quantification, corroboration, and evaluation. Quantification is deferring whether the explanation of error can be explained, the observed difference. So what's the explanation? Go with that. Corroborate explanations by obtaining sufficient audit evidence between the explanation and the information, and is it reasonable? Auditors should evaluate the results of the substantive and analytical procedures to conclude whether the desired level of assurance has been achieved. And our final slide, chapter 5. So we're going to investigate the differences for risk assessment and final analytical procedures. All right, so we're going to corroborating evidence necessary, not required, but we are planning comparing for a risk assessment procedure differences. But corroborating evidence is required if the auditor cannot find sufficient evidence within the working paper. So if we have enough evidence in the working papers that makes sense, great. But if we don't and we're way off, we need to go deeper and say, okay, what are some other explanations? What are some other testing? What are we going to find and how are we going to determine increasing our comfort level with what's going on? So that's chapter 5. And there's a lot of material here. And there are a number of charts in the chapter that you're going to want to take a closer look and take a closer review. But again, it's management's asserting things and we're validating and verifying that those are true. And there's a whole bunch of tests that we go through, need to corroborate. Thank you for listening. We look forward to continuing and seeing you again soon. Take care.